Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 3, this is Section C3, and we're going to be going over both tasks in this area. So first is remembering and understanding, identify capital assets reported in the government-wide financial statements of state and local governments, and we're going to be covering also application, calculate the net capital assets balance, such as including land, buildings and improvements, machinery and equipment, and leases for state and local governments, and prepare journal entries, and we would want to do the initial measurement and the subsequent depreciation and amortization. So we're going to be doing that the Superfast CPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to superfastcpa.com and sign up for our free 1-hour webinar. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then after that, you're going to want to learn more. So make sure you also check out the pro course, the study materials, and the total bundle, which has the pro course and the study materials, and those will help you a lot in your CPA study. Now, with all that, let's dive into this video. All right, here we are at question 1, and something I want to say as we're getting into this, normally these videos for the member version of them, because we're doing the YouTube version right now, but then there's a member version, normally they have basically double the questions. In today's video, we're going over 6 questions, and the member version also only has 6 questions. This is a topic that is honestly pretty straightforward. If you know how to do depreciation, you know how to do a lot of this topic. So really we just had to do, 6 questions to kind of make sure you knew the differences, but I didn't feel like it was necessary to do any more than that. So let's go ahead and dive into question 1. Something I always like to point out is you want to read the last sentence of the question first, because it gives you context for what the question is even about. So let's do that. What journal entry should the city record in its government-wide financial statements for depreciation at the end of the first year? Let's go up to the top. A city purchased equipment for use in governmental activities on January 1st. The equipment cost is $284,000. The city also paid $16,000 to install the equipment and make it ready for use. The equipment has an estimated residual value of $20,000 and an estimated useful life of 7 years, and the city uses straight-line depreciation. So what is going to be the depreciation that they record at the end of the year? Now, like I was saying, if you know how to do basic depreciation from, normal accounting or from FAR or whatever the case is, then you'll probably be able to figure this out. So I want you to pause the video if you need to, do the calculation, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is B. You would debit depreciation expense for $40,000 and credit accumulated depreciation for $40,000. And this question is meant to be simple because it's meant to show you how similar governmental accounting for assets is to normal accounting for assets. So let's dive into this. The depreciable cost is the cost of the asset plus the cost to make it ready for use, less the residual value. So first we figure out the total capitalized cost. So $284,000 plus the $16,000 that it takes to install the equipment. That gives us $300,000. Then we subtract the $20,000 residual value that they're expecting to have at the end of the 7 years, and that gives us $280,000 of depreciable cost. Then we divide it by the 7 years, and that gives us $40,000 of depreciation expense per year. This is the normal depreciation entry. And again, you'll think, well, this is pretty much exactly the same. Well, it is. Most of the time in governmental accounting, at least for the government-wide financial statements, which is what we're talking about, you're doing depreciation pretty much the same way that you would do it in normal accounting. In the government-wide financial statements, the city reports depreciation expense and accumulated depreciation just like a business would for a depreciable capital asset. So I just wanted to start with that. If you know how to do depreciation, and we just kind of went over the basic idea of depreciation or normal depreciation here, if you know how to do that, then you know how to do a lot of governmental capital asset depreciation and accounting. But now we'll go to the next 5 questions to kind of start learning the differences that you do need to know. So let's go to question 2. All right, here we are at question 2. Which of the following would be reported as a capital asset in the government-wide financial statements of a state or local government? Okay, so which one of these is going to be recorded as a capital asset? Read through these options. I want you to pause the video if you need to, or, if you at least want to read through the options, go ahead and pause the video. And when you're ready, come back. We'll look at the answer together just to kind of make sure we understand what's going into capital assets for governments. All right, here we are at the answer. It would be land, buildings, equipment, infrastructure, and right to use assets or lease assets, excuse me. Now, that might sound pretty much the same. And again, it is. Most of the stuff that you would consider a capital asset, if not all the stuff that you would consider a capital asset under normal accounting, is going to be that underneath government-wide financial accounting. So let's go through this. Government-wide financial statements use the economic resources measurement focus, so they report capital assets used in governmental activities. This includes land, buildings, improvements, machinery and equipment, infrastructure, and right-to-use lease assets. Infrastructure, by the way, just to make sure you understand what that is, because that is something that's a little bit unique to governments, or at least it's mainly used in governments. Infrastructure includes long-lived or lived public assets such as roads, bridges, tunnels, drainage systems, sidewalks, and water or sewer systems. Right-to-use lease assets are assets reported when a government has the right to use another party's asset under a lease, such as leased buildings, vehicles, or equipment. So again, those are things, especially the infrastructure, that's something that you probably aren't going to see very much in normal accounting, but underneath government accounting, because they're keeping track of the roads and the sidewalks and all those different things, that's going to be considered infrastructure, and we'll learn a little bit more about the accounting for that in the next few questions. But at any rate, now we kind of understand what infrastructure and right-to-use lease assets are. This is different from governmental fund financial statements, and we've talked about governmental fund financial statements a little bit in previous videos, which focus on current financial resources. Governmental funds generally report capital asset purchases as expenditures, not as capital assets. So again, just a reminder of that difference between government-wide financial statements and governmental funds. But again, we're kind of just seeing that the accounting so far is pretty similar for capital assets and their depreciation and things like that compared to normal accounting. Now let's go to the next question. All right, here we are at question 3. What amount should the county initially report for these capital assets in its government-wide financial statements? Let's go up to the top. A county purchased machinery for $118,000 and paid $7,500 in freight and installation costs to make the machinery ready for use. During the same year, a local business donated land to the county. The land had an acquisition value of $265,000 at the date of the donation. So what are they going to initially report these items as? Are they going to report the full amount of the machinery and the full amount of the land, or only partial, or are they going to add things? There's a few different options here, but think about this. Think about what you know about normal depreciation, normal capital assets, and you'll probably have a good idea of how this goes. And when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C. You would record the machinery as $125,500 and the land at $265,000. Again, this shouldn't be too strange, but this is talking about a rule that you do need to know. Purchased capital assets are recorded at historical cost. Historical cost includes not only the purchase price, but also the costs needed to place the asset into service. Because the freight and installation costs were necessary to get the machinery ready for use, they are included in the capitalized cost. So $118,000, that was the initial purchase price of the machinery, plus the $7,500 of freight and installation gives you $125,500 that's going to be capitalized. However, now let's talk about donated capital assets. Donated capital assets are not recorded at zero, so it's donated, and since you didn't have to pay anything for it, it's not like that counts as zero. You still have to record it as a capital asset. They are recorded at acquisition value, or essentially for fair value for exam purposes. It's acquisition value, but you can pretty much think of it as the fair value at the date of the donation. Therefore, the donated land is recorded at $265,000. The county should initially report the machinery at the cost that we just talked about and the land at the $265,000 in its government-wide financial statements. So we're learning how they initially record their assets. Again, very similar to how you would normally initially record an asset in normal accounting, but there was just that reminder there about donated capital assets. They're not counted as zero, but they're counted at their fair market value, even though you didn't pay anything to get them. All right, now let's go to the next question. All right, here we are at question 4. How should the city report the current year preservation and maintenance cost? Let's go up to the top. A city reports a road system as an infrastructure asset in its government-wide financial statements. The city uses the modified approach for the road system. During the year, the city spent $430,000 to preserve and maintain the road system. So again, how are they going to report this preservation and maintenance cost? So look through these options, pause the video if you need to. We have talked about the modified approach in some of the previous videos. So if you've watched them, then you might have an idea of how the modified approach works. If you don't, that's okay. Again, read through these options. When you're ready, come back. We'll look at the answer together. All right, here we are. The answer is B. You would expense the preservation and maintenance costs, and you do not record depreciation on the road system. So this is where we're going to start learning about the modified approach, because suddenly they're not depreciating an asset. What's going on here? So let's go through the explanation. The modified approach is an exception to normal depreciation for certain infrastructure assets, such as roads, bridges, tunnels, and drainage systems. So specifically for infrastructure, there's this exception. Otherwise, you would have normal depreciation for pretty much most capital assets. If the modified approach is used, the government does not record depreciation on the qualifying infrastructure asset. To use the modified approach, the government must have an asset management system, so they have to have some kind of system that's managing these assets, these infrastructure assets, and they have to document that the infrastructure is being preserved at or above the condition level established by the government. The asset management system generally includes an inventory of the infrastructure assets, condition assessments, and estimates of the annual amount needed to maintain and preserve the assets. So essentially, to be able to use the modified approach, they have to show how they're figuring out the numbers. They have to show that they're doing the maintenance. They have to do all these things so that they can use the modified approach. Under the modified approach, costs to preserve and maintain the infrastructure are expensed. They're not added to the structure as an additional piece of capitalization or anything like that. They are expensed. However, the infrastructure asset is still reported in the government-wide financial statements as a capital asset. So this doesn't mean that we're not reporting it, but we're not depreciating it because we're showing that we're maintaining it at a certain level. All right, we learned about the modified approach there. Everything we've talked about previous to this is technically something called the required approach, or kind of the normal approach to depreciation. So there's the required or normal approach and then the modified approach. Now let's go to the next question. All right, here we are at question 5. What amount should the city report as net capital assets in its government-wide statement of net position? Okay, so essentially we're going to try to figure out the net of the capital assets. So let's go up to the top. A city reported the following capital asset information for its governmental activities at year end. They had land of $410,000, buildings $1,850,000, accumulated depreciation on those buildings of $520,000, equipment of $375,000, and the accumulated depreciation on that equipment was $145,000. They had a right to use lease asset of $240,000, and there was accumulated amortization on that lease asset of $60,000. And then there was construction in progress of $125,000. And then there was infrastructure reported using the modified approach for $900,000. We just talked about the modified approach. And again, take the knowledge that you probably have from just normal accounting or from maybe taking FAR or something like that, and you probably know generally how to handle figuring out the net capital assets of this statement of net position. Basically, what's the end total of adding these and subtracting these all together? So think about it, pause the video if you need to, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is D, $3,175,000. That's the amount that's going to be included as net capital assets. So let's go through this. Net capital assets are calculated by taking capital asset balances and subtracting the accumulated depreciation or amortization or accumulated amortization. Again, pretty straightforward if you know anything about depreciation. So land, $410,000, we're not depreciating land. Buildings was the $1,850,000 less the $520,000 equaling $1,330,000. The equipment was $375,000 less $145,000 equaling $230,000. The right to use lease asset was $240,000 less the $60,000 of amortization equaling $180,000. Then there was construction in progress and infrastructure using the modified approach of $900,000. So we add that all up together and it's $3,175,000. Nothing like that we're excluding there. It's all going to be included, but of course the depreciation and the amortization is reducing the amount for the buildings and the equipment and the right to use lease asset. Something I want to talk about here. Land and construction in progress are not depreciated, and the infrastructure asset is also not depreciated because it's being reported using the modified approach. Like we just talked about, it's being included in the government-wide financial statements, but it's not being depreciated because they are showing and they are maintaining the asset at a certain level. So with that, let's go to the next question. All right, here we are at question 6. This is the last question. How should the city report the donated collection in its government-wide financial statements? Let's go up to the top. A city operates a public museum. During the year, the museum received a donated collection of historical artifacts with an acquisition value of $310,000. The collection is held for public exhibition and education, is protected and preserved by the city, and the city has a policy requiring any proceeds from the sale of the collection items to be used to acquire other items for the collection. So again, how are they going to report this donated collection in the government-wide financial statements? So this is something that's kind of different than anything we've talked about so far in this video. How is this going to be treated? Do they capitalize this? Is this something that is kind of like the modified approach with infrastructure? Like, how does this work? If you have any idea, that's great. Maybe pause the video and think through this and give it your best guess. If not, it's okay with this question because we haven't really talked about it so far. So let's go ahead and look at the answer and start learning about this. All right, here we are at the answer. B, the city may choose not to capitalize the collection if the required collection criteria are met. So they would probably normally capitalize it, but there is a special criteria that you will need to know. Works of art, historical treasures, and similar assets are generally capital assets, so normally they're depreciated in some form. However, a government is allowed to avoid capitalizing a collection if the collection meets certain conditions. The collection must be held for public exhibition, education, or research rather than financial gain. So it's for the public, it's not for gain. It must be protected, cared for, and preserved, and the government must also have a policy requiring proceeds from the sales of collection items to be used to acquire other items for the collection. So again, they're not selling stuff to get a gain, they're selling it to maybe get new items. If those conditions are met, the city may choose not to capitalize the collection. If a work of art or historical treasure is capitalized and is considered inexhaustible, depreciation is not required because its service potential is used up so slowly that its useful life is extraordinarily long. So sometimes sometimes they will be depreciated, but a lot of times probably, think of these works of art or things like that where they don't really age, or at least they age very slowly. You still might not depreciate it, but sometimes you still might. But the big thing that you need to know here is that they can choose not to capitalize it at all if the conditions that we just talked about are met. So that's one last thing that I wanted you to know about capital assets when it comes to governments specifically. That is the last question. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics, if you haven't heard it before, is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach a similar or the same concept, teaching you something about works of art, or maybe teaching you about the modified approach. Whatever the case is, you take note of that and you pull out the pillar topic, the key point that you learned from those questions, and write it down in your own words so that you understand one of the key things that you need to know for exam day. So let's go ahead and take a look at the pillar topics right now. Okay, here we are at the pillar topics. Let's just dive into these. Again, remember, these are basically a summary, or in our own words, what we learned from the questions. So let's do the first one. Unless a special rule applies, depreciable government capital assets are depreciated over their estimated useful lives, or essentially normal depreciation. The basic formula is the same as what we know: cost minus residual value divided over the useful life. Purchased capital assets are recorded at historical cost, including costs needed to place the asset into service. Donated capital assets are recorded at acquisition value, or essentially fair value. At least for exam purposes, you can think of it like that, at the date of donation. If a government uses the modified approach for qualifying infrastructure, it does not record depreciation on that infrastructure. Instead, the government expenses preservation and maintenance costs and must document that the infrastructure is being maintained at or above the established condition level. Lastly, we just learned this: works of art and historical treasures are generally capital assets, but collections do not have to be capitalized if they are held for public exhibition, education, or research, and are protected and preserved, and sale proceeds are used to acquire other collection items. So again, those were like the key things, the main ideas that we were supposed to learn from those questions. And with that, that is the end of the YouTube version of this video. Now, remember, normally there is a member version that has pretty much double the questions of what we go over in the YouTube version. So normally it'd be like 5 questions for YouTube and 10 questions for member versions. Now, this has happened frequently with BAR because BAR has so many kind of small but important topics that this video is going to be 6 questions on YouTube and 6 questions for the member version. But again, normally, especially for the other sections like FAR and audit, there's like double the amount of questions for the member version. So if you found this helpful, make sure to check out becoming a member of SuperfastCPA by either buying the study materials for the exam that you're studying for, or buying the total bundle, because that includes the study materials and the pro course. And the pro course is where we explain all of our strategies on how to pass the exams. Basically the 1-hour webinar, but way, way more in depth, like multiple hours of videos teaching you how to study for the exams. So again, if you're interested, make sure you check all that out. And the easiest way to kind of get started with all of that is by going to SuperfastCPA.com and signing up for our free 1-hour webinar, like I just mentioned, and that will give you a good idea and give you a good place to go from. Now, I hope this video was helpful. If you liked it, make sure to like it and leave a comment, and I will see you in the next one.